Good morning, everybody. Kirk Spano, Investing 2020s. I hope you all had a great weekend. Mine was pretty good. Monday's shaping up to be pretty good, too. Had to go to a graduation party yesterday. I think I've told you that Jolene's friends have a whole bunch of kids that are in that graduation age range. And I think those parties are always interesting because the kids figure out pretty quickly how to handle it. First thing they do is they greet everybody, get their present, get their card with the money in it, and then they go and hang out with their friends. So, it's a dynamic, right? Well, one of the daughters who came to the party, it wasn't her graduation party, but she is graduating. She decided, Mom, instead of spending $1,000 on a party for me to get $1,000 in presents, how about we just go on a trip? So they're actually going to San Francisco. And we talked about it a little bit at this party. And she probably is still going to get close to what she would normally get because people who send presents either way, grandparents and aunts and uncles. So, there's always another summer party to do the collection. So she was the wise one. I'm going to keep an eye on her. I think she's pretty sharp. Anyway, I'm going to cover dividend stocks today. However, because it is one of our largest positions, and I know for me, my largest position, Ametis, I wanted to talk about that just a little bit. So today, they were able to start recognizing some of the renewable natural gas tax credits and sales. So they had been holding natural gas underground, and they started selling it in just the last couple of weeks. This coincides with the numbers and the codes necessary to get the tax credits, and the price of the tax credits in California are on the rise. So you have not only the federal tax credits, but you have the LCFS tax credits in California that have gone up about 30% in the last month. And that's because the state of California wants to push them up from the low of 65 to the current 90-ish. I'd have to pull it up and look, all the way up to around 200 or 250. So the tax credits that Ametis is getting, and other companies in California will qualify for as well, are pretty juicy, to the point where Ametis might be able to realize around $50 million of added revenues over the course of this year. Everybody was wondering where the money was going to come from. He told us this was one of the first places it would come from, the CEO, Eric McAfee, and lo and behold, here it is. There are more to come. We have more India contracts coming, not only on the biofuels, but they have cut deals on tallow, which, again, I didn't really understand in the first place, but it's a pretty tight market, and they got a supply, which will help with other production needs in the United States. So Ametis has finally started to squeeze the shorts pretty well, opening up. I think it's near its high of the day right now. Take a quick look at the chart. I know this is about where it opened, then it dipped a little, and now it's back up there. Okay, so I know it spiked here. So it is at the high of the day, roughly. Now, there's people out there who want to trade it, and they want to say, oh, I'm up, 20%, and they want to take the profit. Now, I have started scaling out of my July calls, and I only hold just a little bit of those at this point. So if you have July calls, I strongly suggest you start scaling out, and I would do it pretty much this afternoon. You can do it right now. Click, click, click. Don't have to sell it all because this might just keep on going up for the next month. There was just an article, I forget what publication, but it was listed as one of 9 stocks likely to get a short squeeze because it had already broken through the initial resistance. So this could still go 7, 8, 9, 10, 11, 12, 17, $22 a share in the next couple of months. I have said that I think that Ametis gets to around 20 by the end of the year. 17 to 22 is my range. We'll see. It might do that by August earnings or just after August earnings. And it might go even higher if at the November earnings, they start talking about the India IPO. Now, something about that India IPO that you should remember is they're not selling the whole refinery business. All they're going to do is float 10 to 20% of the shares to establish a market cap and raise some cash. I believe they're going to float about 10%. That was my read on the look on their faces when I started throwing things out. I think that they're going to float about 10% on that company, raise $70 to $90 million net early next year, like he said. And then we'll see, because if that plant keeps becoming more valuable as they expand it, the buyout could be massive, or return on investment could be very long term, because it's going to take at least 20 to 30 years for India to dramatically reduce their fuel usage. Now, I just want to mention something that did happen yesterday. We saw what in the OPEC negotiations? What do you think you just saw yesterday when Saudi Arabia had to impose production cuts and then do it all by themselves? What is happening from everybody else that produces oil? Why wouldn't they cut anymore? I gave it a term. What is the term that I gave to what was going to happen? There you go, Tom. Panic pumping. We saw yesterday, and I'm going to write this article tonight, we saw the first panic pumping already. Remember I told you it should happen in 2025 or 26? It happened now. So the change in the energy infrastructure is happening so fast that people don't even recognize what's going on. The nations of Africa and Venezuela and everywhere else that has oil to produce, they know that the EVs are coming in the middle of the decade and ramping up, probably be 50% of sales easy by the end of the decade. I think closer to 80. This is on passenger cars, not heavy duty trucks. Got to remember, when you take a look at over the road vehicles, diesel fuel is incredibly easy for them to use, and those trucks last a very long time. So diesel is going to be around quite a while. And for companies that have a way to make the diesel cleaner, or range extenders like Ametis has in its back pocket, maybe it comes to fruition, maybe it doesn't, with diesel engined trucks are going to be around a long time, 20, 30 years again, especially in foreign markets like India. So I'm dropping this out there because there's a big picture thing here about what's happening and the types of companies that are going to be hurt and the types of companies that are going to be helped. Ametis is in several sweet spots. Now, one of the sweet spots they're in is carbon capture. Now, the interesting thing about carbon capture is that the technology is what dictates how successful it will be. So the giant carbon sucker machines that they want to build to get carbon out of the air isn't a very proven technology, and it's expensive. But what Ametis is doing, by doing it through their fuel system, right, through their refineries, through the process of making biofuels, that works. That's easy. Not easy, but it's proven. So when you hear about big carbon capture projects, you really have to take a look at how they're doing it, because the devil really is in the details. Ametis has one of the simpler ways of doing it versus some of the gargantuan complicated ways. Do you want to bet on keep it simple, stupid, or a contraption that you can't understand? I think it's pretty easy. Now, people are asking, can I still buy Ametis? I've said I think the stock is going to be between 100 and 150. That's based on getting it to a market cap of between $3 and $5 billion 3, 4, 5 years from now. I personally believe that the company is worth $1.5 billion right now, just based on the level of business they have and the hard asset, net of debt. When they finally have air jet fuel, remember we decided not to call it sustainable air fuel, right? SAF. We decided not to call it that. I decided after seeing the Air movie, I'm just going to call it air jet fuel. Or did I say air biofuel? Oh yeah, that's right. We're going with air biofuel. I better write that one down. I haven't typed it up yet. Air biofuel. Let's copyright that right now. Everybody say air biofuel, so it's officially a copyright. There you go. When they finally are doing the air biofuel, all those revenues, $7 billion in contracts. Think that through. I mean, seriously, think that through. They've essentially just proven that they're going to be able to finance everything. That's what the significance was today. They're dropping all these revenues to the bottom line between the government loans and these revenues, right? They're going to be able to do the liquidity event with Third Eye to pay off a bunch of that. Now, all of a sudden, people are going to go, oh, not only are they going to make it, but they might have the highest margin refinery in the world. That's not hyperbole. The double-decker tax credits on top of what is a pretty good margin business means that they're literally going to gush cash once everything is up and running. And we know that these tax credits stay in effect till 2032 on the federal side. We got 9 years of Uncle Sam handing this company money. If you don't have a full position, buy the dips this week, get to a full position. I'm way past the full position. If you want to get in on those calls for a rally up to around 20, the January $7.50 calls, just monitor them and set in a couple good till cancel buys, maybe 15 or 20 cents below the price now, and then another 40 or 50% below, right? Because it's going to be volatile, because we know the summer is going to be, interesting. I point out that on the guy who said to stay away from Ametis, I decided to comment on his article and said, let's just follow the chart. He wanted to compare Ametis to Opal, which is like 1/3 the business that Ametis is. Not that it's a bad business, but it's about 1/3 the business that Ametis is. So we know that the debt limit drama has just started. I've been warning you about this for weeks and weeks. We knew that they were going to come to a solution on the debt limit, and everybody thought, oh, that's great. People just don't understand what's coming next. It's covered in Forest for the Trees this week. If you're one of the folks who subscribe to that, I'm writing another article about it today. But the summary is the U.S. Treasury has to refill its general account, about $1 trillion over through the end of the year. We don't know exactly how much that's going to suck out of the financial system, because there's different buyers of the debt. Foreigners, American funds, the banks, which soaked up a ton of it the last time. But there's also that $1 trillion slush fund that I told you about 3 years ago. I said it was interesting to me. 3 years ago, I told you this. The Fed has a $1 trillion slush fund for handling the repo market, and they can buy some of this debt if there's a shortage of buyers. So you have your American institutions, you have your international investors, you have the banks, then whatever is left, the Federal Reserve is going to buy. I showed you the Federal Reserve balance sheet last week. No point in beating you over the head with it. But it spiked up on the bailout for those banks, and then the QT pushed it right back down. So as the coffers are filled again for the U.S. Treasury, we'll see if the QT and the buying in that market balance out, or if the Fed balance sheet goes up or down with it. We'll see. It's hard to know. We don't know what international demand is. However, we do know that with the exception of China, really hasn't fallen off. So it'll probably be a little bit of Fed buying, but not much. And I don't think it's going to be more than what they're getting rid of on the QT side. I think you're going to see a choppy Fed balance sheet through autumn, which is what I told you the last couple of weeks. Now, that liquidity coming out of the system means that we not only have the seasonal summer slowdown, the QT, and the stressed out regional banks, but we have the big banks buying Treasury bills, which is what they're going to issue. Janet Yellen told us that they're going to do bills versus bonds. And people are asking, well, if the long end was a lower interest rate than the short end, why are we doing short end? Well, the answer is so that it's gone in a couple of years. That's one of the reasons why they flattened out the spending. I think you should expect another deal like that in a couple of years. They're going to flatten out federal spending, and they're going to close loopholes, and they're going to push towards a balanced budget faster than anybody believes. And you know why it's going to be faster? Because nobody believes it can happen. But they're going to get to the point where the annual deficit is less than the inflation rate. And it's going to happen pretty quick. And then when the baby boomer bust comes, there'll be a massive multi-trillion-dollar bailout. The stock market will scream up after it crashes. And people will say the same things that they say now, which are still wrong. Dollar is going to crash. The United States is post-hegemon. Blah, 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 blah. Dollar is not going to be reserve currency. Blah, 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 blah. Weimar Republic. Blah, blah, blah. How many times do you have to hear the same pile of shit from the narrators and have it be wrong before you go, oh, that's just not how it works? I just told you the future of the world, and we're going to make a lot of money on it. Because for whatever reason, the combination of me not getting dumber and learning more and meeting people and getting more experience, I think we're going to mint money. I really do, especially those of you who get involved in that private real estate stuff, because it's kind of blowing my mind that they can do what they do. And I'm going to talk about a couple of investments that are a play on that as well. So let's scroll down. There's other things coming too. Morgan Stanley just warned of an earnings wall. Maybe that's right. Maybe it's not. I think it is. Typical late market for a bear cycle is that large caps finally fall. And that marks really the end of the bear market. And the early cycle is that small caps tend to outperform. We are already seeing that change in leadership right now. So dividend stocks. Microsoft overvalued, trim it. Apple overvalued, trim it. Don't have to sell out, but maybe you take the money that you've made in the last year or two or three since COVID and you cut it back. Take a look at what your asset allocation was to Microsoft and Apple a few years ago and then pull it back. For me, I don't want more than 2% of my portfolio in Apple or Microsoft. Why? Because I trade QQQ a little bit, and we're going to do a little bit more of that over time as well for those of you who are interested. Ford, it's undervalued, has huge upside on EV surge. The real estate that they're going to get freed up as they shift to EVs from internal combustion engine vehicles is pretty significant. They have the technology through fourth industrial revolution advances to do joint ventures or just become a giant conglomerate. I'm going to tell you the truth right now about Ford that I don't really put out there too often, and a few of you have heard me say it, and I haven't written it yet. I think Ford is going to end up being a conglomerate that pushes into the military industrial complex a lot more than it has already. I think that they are going to get into healthcare more. I think they're going to get into all sorts of things to potentially make it at least a $500 billion company. But I think probably Ford is a company that you see maybe join the ranks of those giant, huge $1 trillion companies at some point. Take a decade or longer. Based on where it is now on market cap, would you take a 10-bagger over a decade with Ford and still get your dividends along with it? I think most of you would. To me, Ford is the top dividend stock in our list. Now, it'll take a little bit more execution for Intel to get there, but they have massive upside too. NVIDIA said that they'll probably use Intel for some of their chips as they diversify. That's an important concept. So many companies were doing business with Taiwan Semiconductor. Now that Intel is entering the space, they can diversify their production. Good for Intel, bad for Taiwan Semiconductor. Oh, and by the way, Taiwan Semiconductor might get bombed a few times. Pfizer, it's coming down to fair value. I think for dividend investors, I think for folks who are retired, Pfizer from the right price is an awesome stock because they have very little downside once you buy them in a cheap enough spot, so you get all that margin of safety. So from the middle to lower 30s, I think Pfizer, has upside back up to 60 from there. It has upside to 60 from here too, but why would you buy it in the 40s if you can buy it in the 30s? I think it might be 38 or 39 right now. And it has a nice dividend. So it's one of those stocks that if you're a retiree, you can say, okay, this should beat the S&P 500 by a little bit, and I collect some income. And I can sell covered calls and cash secured puts from time to time because the healthcare cycle has some volatility. And I can maybe catch a few extra percent every year because of that. American Tower. You'll notice that I took CCI off the list a while back. It's not even on the VSL anymore. Crown Castle, don't have it, don't want it. Why? The American market is essentially mature. The American Tower has awesome management, and they made the pivot towards emerging markets years ago. And they even have a piece of AST Space Mobile. So American Tower on these pullbacks is very attractive. I think we probably have to really pay attention as it goes down just another $5 or $10. But if we get a push to the 130s, holy cow, gonna have to back up the truck. They have a lot of upside. And as their debt comes down, as their industry matures around the world, and they get their cut from the space operations, it's just going to be one of those companies that gradually whittles down the debt, amps up the dividends and the buybacks. I think it's very easy to see out over 10 years that American Tower not only beats the S&P 500 just on pure growth, but could kick you 5, 6, 7% a year in shareholder yield on top of that. Kinder Morgan. The acquisition upside is when Richard Kinder dies. Meanwhile, you get to collect a 6% dividend. And as the carbon market develops, they have upside from that too. That's really not priced in at this point. Nobody even thinks about carbon capture and carbon transportation in particular. Why? Who knows why? Who knows? The narrators haven't turned it on yet. AT&T. Stock market is clearly beating it up for bad reasons. Amazon's not going to compete with them. Amazon might use them, but they're not going to really compete. Amazon wants to get their phones in the market. They don't want to operate telephone networks. So we'll see what goes on there. My guess is Amazon offers a unlocked phone. I think they might already do it to put on any network you want. Maybe they'll offer some sort of incentive to do it. That said, I'm not all that excited about AT&T only because the things that I think should happen are going to take a long time. And one of the things I think should happen, they really haven't talked about much. Now, I still think that the AST Space Mobile connection is a big deal. However, the damn stock just doesn't go up. And at some point, you go, oh, so here's where I'm at. If you're a retiree, this is essentially a utility at this point. There's almost no downside from these prices. The upside, however, is very unclear. Now, I think because I'm depressed about it, it probably means it's about to jump $7. However, who knows? So for growth investors, I'd say don't bother. Just own AST Space Mobile and American Tower. Those are much easier to forecast. So I don't look at AT&T as a growth stock, but it's a great dividend stock. The income is high. Should go up eventually with fiber and AST Space Mobile and competing Roku and everything else. But boy, oh boy, talk about a decade-long beatdown. So it's probably ready to rock and roll, but it's easy to get depressed. So I thought I'd work you through my range of emotions. I think growth investors can do better, but dividend investors, it's probably still a pretty good one. Fifth Third Bancorp. I'm not ready to buy banks. I think that this crisis in the regional banking sector is maybe in the third inning, maybe the fourth, maybe the second, who knows? Early in the game, but past the start. How's that? But I really like their mix of business. I mean, take a look at their geographies, take a look at who they focus on. I think Fifth Third is a bank that probably is a winner as regional banks merge, but we need to see how it plays out, and we need a cheaper price to build in that margin of safety. So if it gets down to around 20, I think that we really, really pay attention there. Some of the non-S&P 500 stocks, New Fortress Energy. I've talked about the fast LNG. They're finally going to get it up and running. First plant is launching imminently or starting to operate imminently. Their EBITDA is going to rise again. It went from about 600 million to 1.1 billion. And this year, it looks like it's going to be close to 2 billion. As a heck of a growth curve. Now, the CEO, who's a large shareholder, Lazary, Bucks owner, likes to throw off those variable big dividends. And he'll do some creative financing to do it, especially if he knows the cash is coming in through the door right afterward. So while the regular dividend isn't high, if you take a look at what the payout was last December, you go, oh, so this is a great one to own for the growth, but also those variable dividends are pretty large. It's a lot like private equity does, and it's mainly because Lazary is a private equity guy. So I think that at under $30 a share, you really have to be looking at a way to get to a full position in New Fortress Energy, because their LNG technology of being able to load it right at the wellhead in the ocean, freeze it right there, transport it to wherever it's got to go, which usually isn't very far, is powerful. And they're adding more and more contracts. So this is a stock that their EBITDA, could go to 3, 4, 5, 10 billion over the next 3, 4, 5 years. Just drop in more of those plants, right? Permian Resources. Because we just saw the first panic pumping, I think you have to be very careful because it came faster than I thought even. And I thought the panic pumping would happen way sooner than anybody else thought, right? Who else is saying panic pumping is coming? It's here. It just happened. OPEC told Saudi Arabia no more cuts to our production limits. And a lot of them don't meet their limits anyway, but they didn't want those limits lowered because they want to produce more. So I think that Permian Resources will get a rally here because the market is tight. Saudi Arabia is supporting the oil market. The EV sales haven't taken off yet. It won't for about 3 years, maybe 4. But I'm looking at 2025 probably as an exit on Permian Resources, on merger, rumors, whatever. A price in the 20s is what I think, but we'll see. In the meantime, we collect a pretty good dividend. But if we get more signs of panic pumping, if the oil market starts to fall apart, you got to just get rid of it. So keep that in the back of your head. I think we're okay through next summer. I think we're okay through the summer after that. But I just don't think I want to own Permian Resources into 2026 when those EV numbers start coming out, right? That's when all the plants are up, right in the heart of tax incentives, lower battery costs, right? Did you know that the lifetime ownership of an EV bought today will be cheaper than an ICE vehicle? Did you know that? An equivalent ICE vehicle. Sticker price is high, but the longer term ownership, the life of vehicle ownership, I believe they do it at 6 years, which is way shorter than it should be. I'd have to double check that. It's cheaper now. What happens when the sticker prices are the same? Now it becomes pretty easy for people to, same sticker price, give or take, and super cheap to operate. No oil changes. And that's $600 a year for some people. So keep an eye on that. This energy transition is picking up steam. We want to buy all the corrections on the energy transition, and I think we're going to get that this summer. And we'll talk about the ETFs another time. Blackstone and KKR, same thing. Very similar to how they structure the dividends. It's New Fortress, but they're basically the same boat. I like to own them both, maybe half positions. Not right now. They have to get down to the cyclical low points for private equity, right? Because you want to take part in these big rallies. This was an obnoxiously big rally. So I think a price near 60 for Blackstone, right? It'd be above that point is probably the spot. Again, if it looks like we're getting a zombie apocalypse, so then we have to think about a lower price. But absent an Armageddon zombie apocalypse, I think right around 60 on Blackstone and right around 40 on KKR. And we'll watch it in real time. I've updated all the charts here anyway to the VSL, which I bought some software. So now the dividend yield is right every single time. Isn't that nice? Did I just close my article? Oh, there it is. All right. Now, Vici. I want to talk to you about Vici. So you see all the bullish articles in Seeking Alpha and everywhere else. I'm going to tell you something. I understand Las Vegas better than all of them. I don't think there's a single, there's one service that specializes on Vegas and entertainment. So maybe he's better. I subscribed to him for a while, but he wasn't active, so I got rid of it. All these other guys, all these REIT experts, I'm just telling you, they don't know shit about Las Vegas. Vici has loaded up on debt, and the debt is going to be tight for them for a while, and their growth is going to slow soon because they're buying casinos. There's not many left to buy. That means that if they want another casino, or if they want more casinos, they probably have to start developing them. It's more expensive usually. And the permitting process and everything else, and where it's legal. Is there an Indian tribe that says no? How much more can you put in Atlantic City and Las Vegas, Reno, whatnot, California? So Vici is going to run into growth problems very soon. And I think that's going to hit the stock. But then here's the flip side of that. Gambling's never going away. Ever. So what'll happen is they'll just start pounding down debt, buying back shares, and raising that dividend. And I think they'll focus on buying back shares. If we can get Vici in the lower 20s or around 20, I think that's where it's headed, then it becomes a screaming buy. All these guys saying buy it up here, right? Where were they? We talked about buying it in here. It's not going to get all the way that low again, absent an apocalypse. But I think it makes a run into here. I mean, the chart even looks that way to me. So if this summer it makes a run, it does one of those $6 drops in 2 days, and then you look for it to level out and get choppy, and then you buy it. I think it's very likely that happens. I'm probably going to put this behind paywall on YouTube, but also do an unlisted for those of you who aren't buying Shooter's Chart School. Innovative industrial properties. I love the layered catalyst. At some point, cannabis is welcome into the financial system. That'll be awesome for innovative industrial. There's still a bottoming out in the price of cannabis going on. Really, we have no shortage of weed, none at all. But as that shortage turns into equilibrium and the margins start to become sustainable again, right? They're not just blowing out inventory. The stock will stabilize. I think around 60, we'll have to see. But innovative industrial is going to start producing, and they're doing it in one or two places already, more vegetable crops. I've been talking to my farmers again. It is very hard to grow vegetables. It's hard to do, and most of the arable land is going to have to go towards soy, wheat, and rice, and corn. So if you want a lot of fresh fruit, you got your orchards. But if it's not a tree fruit, it's going to be very likely grown, especially strawberries, most berries, in a greenhouse. And we are woefully short on greenhouses. Woefully. If any of you are going to build a house, consider building a greenhouse off the back of it. That way you have your 3 or 4 season room, place where the allergies are made lower, get some butterflies in there to pollinate, unless you're A-okay with bumblebees. But I like innovative industrial a lot. The dividend is huge. It's well covered. It looks like they've gotten through the financial issues. I think we just need one more hit on the stock price. I think we're going to get it. Staying industrial. I love their approach to upgrading facilities. It's a similar company to Prologis, except Prologis is gigantic. It's harder to move needle. Stag goes into markets where you have second and third tier industrial buildings and warehouses. They upgrade them. They bring in higher margin business. Along the highways, you have towns all over the place with little industrial parks that have been hollowed out. And Stag is just continuing to go through those hollowed out industrial parks along the towns that are along the highways or in the towns that are along the highways, fixing them up, turning a buck. I think it's a great business. Just keeps pounding out money. We get one more leg down. We get an opportunity to buy it. Well, I'd love to buy it down here. But this line right here, it's bounced 4 times off of it. I think we have to really think about getting into it in the upper 20s. If we get it in the lower 20s, I think we're just lucky. That means that some zombie hit it, and that's great for us. Digital Realty Trust, I explained last week, we're waiting for that market to bottom out before new growth hits, and I think that we're really close. EPR, I'm adding back to the plug and play after taking some time off. I think that they have done a good job managing that company. And I told you back in 2020 that management really was great, and they are. It's just fantastic management. So going into a mini recession, which is what I think we're going to get, I think EPR probably gets beat up with that, along with the tight liquidity over the summer. And I think in the next quarter or two, we can buy it, get that big dividend, and then have the upside as they figure out how to remonetize their theaters. The theaters are priced at zero, and they're not worth zero. When I drive by this one theater that we go to, or when I go there, I think about what I could do with that property. I think the EPR is going to do what I think I would do if I owned a theater. I'd make it a combination. What is that place called? Buster's or something in Buster's, whatever. I think you know what I'm talking about. I'd make it a combination sports bar and a place where you can do corporate events, as well as keep maybe half of the theaters. Be able to watch sports events like it's at a sports book. Giant screens. Big screens. 1 million TVs. Super high ceilings, right? So everybody feels a little safer. Fans up there. Yeah, Dave and Buster's. I knew it was whoever in Buster's. Dave and Buster's. There's so much you can do with these places because of the space and the cheap square footage. I think that they pull it off. So I'm really interested to see what EPR does over the next couple of years, and I want to get into it because at a private business level, if I was, if I had the time to run one of these things and get it off the ground, I'd do it. I have an indirect connection to the CFO of Marcus Corp. I really want to take a look at buying the theater that they don't want anymore. I just think the amount of money that you can make at these places, if you turn it into 3 businesses instead of 1, is pretty enormous. So we'll see. In any case, I thought I'd run through these for you. I'm going to do the same thing with the growth stocks probably tomorrow. I'm going to do the ETFs on Thursday. So we'll do the same sort of presentation on Thursday for all the ETFs. And don't go diving in with what you have left in cash just yet. You want to keep what you own for the most part, some trimming. If the RSI and anything you have on the weekly chart is approaching 70 or over 70, right? Covered call against part of your position. I'm going to do a retirement income article on that as well, but I don't really know what you own. So if you own something and you think, you check to see if the RSI is above 60 on the weekly chart. If it is, ask me, hey, should I write covered call on part of this? And I'll try to do a little fundamental and a little bit of charting for you and take a look at the options market. So put that in the chat. Hey, I'm wondering if I should put a covered call. I'm wondering if I should write a covered call on, Wacky Widget Company. All right. I'm going to get this up this afternoon, actually. And I've got 4 more articles coming over the next couple of days. Maybe 5 or 6, actually. We'll see how much I can crank out, how fast I can do it. One other thing, when I do the growth article, I'm adding a name to that one too. Don't tell your doc.